Welcome back. It's time for the Word on Wall Street. Top investors watching your money. Joining me right now is Michael Lee, strategy founder, Michael Lee. And here all morning is Mark Tepper. Mike, thanks for joining the conversation. Great to see you. Let's talk about what is to come with futures in the green this morning. Starting the final trading week of August, believe it or not. We're looking ahead to the second read of second quarter GDP coming out on Wednesday, and the Federal Reserve's preferred read on inflation, the August PCE index, coming out on Thursday. Meanwhile, Federal Reserve Chairman Jay Powell admitted that inflation is still too high when he spoke on Friday at Jackson Hole, and he also said that bank lending is tightening. What's your take on all of this?
Yeah, the Fed is in the position they created largely by themselves. They were too late to raise and a little bit too slow to start. And so we're in a situation right now where the economy has slowed down. Bank lending standards have tightened dramatically because of the deposit flight post Silicon Valley Bank. And we are going to get another inflation reading, which we'll see if it starts to reflect the higher prices in oil. A lot of what we've seen in the decline in inflation over the last 6 to 9 months has a lot to do with the price of oil declining. And I know that's not included in core CPI or core PPI, and a lot to do with the core PCE. But when you started looking at the PPI numbers trickling down, you could read the responses talking about how the cost of energy declining had a huge impact on the price of everything else. So now we've seen the price of oil go from $60 a barrel up above $80 a barrel. Does that start to tick up? And I think the message we got from Powell on Friday is that rates are going to be higher for longer, and they have a potential to go even higher from here. I'd say that's particularly worrisome given that last September, we got 75 basis points. A year ago, October, we got 75 basis points. And a year ago, December, we got 50 basis points with a few more hikes coming this year. None of those have really had time to hit the economy. There's a huge lag time from rate hikes to when it actually, when the rubber hits the road, could be as much as 2 years at a minimum, a year. So that you're starting to see that in the price of stocks. And with the slowdown elsewhere in the world from the middle of July, the dollar started getting much stronger, and that's contributed to the pullback in the NASDAQ, and this will be the worst month for the NASDAQ in some period of time.
Yeah, Mike, here's his line on the bank tightening. He says, beyond changes in interest rates, bank lending standards have tightened and loan growth has slowed sharply. This is different. This is subtly different than what he has said in the past. In the past, it's been, oh yeah, higher interest rates, cause a slowdown in growth. Higher interest rates can trigger tightening. There was none of that this time. It was just beyond changes in rates, bank lending standards have tightened and loan growth has slowed sharply. What does that mean for earnings, Mike?
Well, I don't know how much it's going to impact earnings in the near term. I'd imagine what it's going to impact is bankruptcies. You're going to start seeing more defaults, more bankruptcies, tougher to get credit. And again, the reason why this is taking so long to play out is because the Fed decided they had to bail out Silicon Valley Bank instead of letting it fail. And so on one hand, the Fed is tightening. On the other hand, they have special programs for banks to create liquidity. That's ballooned to $1.5 trillion, right? So every bit of quantitative tightening they've done has been offset by these emergency programs. So you're delaying the inevitable and I think making the eventual problem worse. So these tightening, you need tightening in lending standards. We need to take liquidity out of the economy. Otherwise, inflation will never get back to 2%.
Well, Mark, liquidity is certainly coming out of China. China's Evergrande resuming trading today after plummeting. The company lost $2 billion in market value following a